Welcome to the best investment writing, your gateway to the minds of the world's most respected investors. Join us as they unveil the insights gleaned from their tireless research, providing you with invaluable perspectives to enhance your own investment journey.
All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Hi, this is Kai Wu. I'm the founder and chief investment officer at Sparkline Capital. Sparkline Capital is an investment management firm applying state-of-the-art machine learning and computing to uncover alpha in large unstructured data sets. We manage a few investment funds, including 2 ETFs. Now, let's get into the episode. I'm going to read a piece called Partisan Investing, which I published on October 23rd, 2024. The paper contains around 30 exhibits. If you want to follow along with the visuals, you can find the paper on our website at www.sparklinecapital.com. That's www.sparklinecapital.com. Election risk. Political polarization. With the U.S. presidential election only 2 weeks away, many investors are concerned about how a Trump or Harris administration might affect their portfolios. In an extremely close race, however, the outcome is essentially a coin toss. Unfortunately, this coin toss may prove especially impactful for investors due to the two candidates' sharply diverging ideologies. According to the JP Morgan analysis below, if elected, Harris or Trump would be the most liberal or conservative U.S. president of the past century, respectively. The candidates' ideological divide leads to starkly divergent views on key economic policy areas, such as foreign trade, taxation, immigration, and regulation. This creates massive uncertainty for investors, with implications for all sectors of the economy, ranging from big tech to healthcare. However, political polarization is not specific to these two candidates, or even politicians in general. Over the past few decades, the entire U.S. electorate has become more and more partisan, with liberals and conservatives increasingly unable to find common ground. Democratic and Republican stocks. In this extremely politicized environment, stocks are now increasingly considered, quote, democratic, unquote, or, quote, Republican, unquote. The most obvious example is Trump Media and Technology Group, DJT, effectively a meme stock. However, almost every firm has some degree of exposure to partisan politics. In Exhibit 3, we classify Republican and Democratic stocks based on their political contributions. On the Republican side, we see names like Valero, Geo Group, Blackstone, Altria, and on the Democratic side, Fluence, Exact Sciences, Disney, and Google. The classifications are intuitive. Oil and gas companies tend to favor Republicans, while the renewable energy sector supports Democrats. Big tech is overwhelmingly liberal, while materials and financials lean conservative. This partisan divide reflects differing stances not only on social, but also economic issues. Firms rationally tend to support candidates favorable to their commercial interests. As we show later, these partisan stocks respond as expected to the changing odds of a Trump or Harris victory. Follow the money. Government for sale. While inflation in the prices of consumer goods and services is a contentious electoral issue, perhaps the most insidious inflation is in the cost of elections themselves. Elections have become increasingly expensive and are set to reach an all-time high this election cycle. In Investing in Influence, a paper we published in November 2022, we showed how Federal Election Commission, FEC, data can help us track the flow of contributions to candidates. In Exhibit 5, we highlight Timothy Mellon, whose $150 million in contributions make him the largest individual donor so far this election cycle. The exhibit shows how Mellon's contributions flow through PACs or directly to end candidates, either in support or opposition. We identify 3 types of corporate contributions. First, firms can contribute directly from their treasuries. Second, they can sponsor corporate PACs, which bundle employee contributions and direct them to candidates and other PACs. Third, we give firms credit for self-directed donations from their employees. We assume politicians still feel beholden to the employers responsible for their donors' livelihoods. Exhibit 6 shows the breakdown for U.S. public companies. We split employee-directed contributions into those from executives, such as CEOs, and ordinary employees. Of these contributions we have mapped to public firms, 39% are corporate-directed and 61% are employee-directed. Employee donations are split evenly between executives and ordinary employees, while corporate donations mostly come from corporate PACs rather than treasuries. Exhibit 7 shows the publicly traded firms that have made the largest donations so far in the 2024 election cycle. Tesla and Coinbase sit atop the league table due to massive contributions from Tesla CEO Elon Musk and Coinbase's treasury to the America and Fairshake PACs, respectively, which we discuss later. 3 financial firms also make the list due to the largesse of their billionaire executives. Examples include Blackstone, Interactive Brokers. However, we also find firms whose political influence stems from hundreds of small donations, either self-directed or bundled by corporate PACs. Some examples include Boeing and Amazon. Partisan stocks. Next, we compute the share of each firm's contributions to Democratic and Republican candidates. Let's start with an example of Google. Exhibit 8 shows the flow of donations from the firm and its employees to its top 24 candidate recipients. We also illustrate if funds flow directly to candidates or indirectly via intermediate PACs. First of all, we find that Google's political contributions are nearly all employee-directed, 89% of the total. Furthermore, its employees, both executive and non-executive, are almost uniformly Democrats, 86% of total. While its corporate PAC is more bipartisan, it is tiny by comparison. Exhibit 9 repeats this analysis for the rest of the so-called Magnificent 7 big tech stocks. Google is not alone in favoring the Democratic Party. Apple, Nvidia, Meta, Amazon, and, to a lesser extent, Microsoft are all also partisan Democrats. Tesla stands out as the clear outlier due to its CEO Elon Musk's $75 million in donations to Trump and other conservative causes. More on this later. Next, let's zoom out beyond the Magnificent 7. In Exhibit 10, we repeat this analysis for large cap stocks from across the political spectrum. On the Democratic side, we find that Netflix is even more uniformly liberal than Google. Ford, which was neutral in the 2022 election, has swung to the left. Aerospace and defense firms Boeing, American Airlines, and General Dynamics now hold down the bipartisan center. On the right, we find Eli Lilly, Amgen, Phillips 66, and Interactive Brokers. As noted earlier, certain industries tend to favor one party or the other. We confirm this in the next exhibit, which computes partisan donation share at the industry level. Technology, media, and household product companies favor Democrats. Conversely, energy, materials, and utilities support Republicans, as do food, beverage, and tobacco. Financials, healthcare, and services are more bipartisan, supporting the two parties relatively equally. That said, significant firm-level variance also exists within industries. The next exhibit highlights some examples. Within the capital markets industry, BlackRock has earned a reputation as a champion of, quote, woke capitalism, unquote, while Interactive Broker CEO is a longtime Republican donor. Within retail, Tractor Supply sells to the rugged, rural consumer, while Zumiez caters to younger, suburban buyers. Party affiliation is also related to geography. The next exhibit shows the political bias of each state based on the location of company headquarters. As expected, the West Coast is liberal, while the Midwest and South are conservative. Interestingly, the Northeast actually leans slightly Republican. This marks a shift from the 2022 midterm, when the Northeast was slightly Democratic. On the other hand, Michigan now leans Democratic, due to the leftward shift in the Detroit auto industry mentioned earlier. As discussed in Intangible Value, a Sixth Factor, a paper we wrote in May 2023, investors often decompose their portfolio risk into factors, most notably size, value, and quality. The next exhibit examines partisanship from a factor lens. Democratic stocks tend to be large-cap growth stocks, given their overweight to big tech. Conversely, Republican stocks tend to be small-cap value stocks. While Republican stocks offer better value than Democratic ones, they have worse quality exposure. Most investors do not hold concentrated portfolios of just a few stocks. Instead, they buy exchange-traded funds, ETFs, that own broadly diversified portfolios of stocks. Exhibit 15 shows the partisan exposure of popular ETFs. The S&P 500 is heavily tilted towards Democratic stocks. This is because its market cap weighting scheme means placing a lot of weight in left-leaning big tech stocks. The S&P 500's equal weight ETF, which doesn't follow this cap weighting scheme, is much more politically balanced. Meanwhile, the NASDAQ 100 and Russell 1000 growth ETFs, which hold a lot of tech stocks, are even more exposed to Democratic stocks than the S&P 500. On the other hand, the Russell 1000 value ETF is more politically neutral. As we saw earlier, the value factor is Republican, providing a counterbalance to the liberal bias of cap-weighted indices. Partisan stock returns. Should investors prefer to hold Democratic or Republican stocks? Exhibit 16 shows the historical returns of Democratic relative to Republican stocks. Over the long run, the returns of Democratic and Republican stocks have been mean reverting. No systematic advantage exists for investing exclusively in the stocks of either party. That said, these stocks can still exhibit large, multi-year deviations, mostly reflecting the industry and factor exposures seen earlier. Democratic large-cap, growth, and tech stocks outperformed in the expansion phase of the dot-com and COVID bubbles, while Republican small-cap financial and resource stocks outperformed in the period leading up to the 2008 financial crisis. In theory, the relative returns of Democratic and Republican stocks should reflect the shifting balance of power in D.C. Exhibit 17 shows two sources of real-time forecasts for the 2024 election. Real Clear Politics produces a composite of traditional polling data, such as CBS and Pew, while Polymarket provides odds implied by prediction market traders. The two sources are highly correlated, but not perfectly. This is expected, as they quote in different units of measurement. For example, favorability spread versus win probability, with one tied to the popular vote and the other to the Electoral College. Rather than wade into the contentious debate over the relative merits of prediction markets versus polls, we'll just consider both sources. In Exhibit 18, we show how changes in Trump's election odds, based on Real Clear Politics and Polymarket, relate to subsequent Trump versus Harris stock returns. While only a short time period, we find a strong 77 to 88% correlation between increases in Trump's election odds and subsequent Trump stock outperformance. After Biden's poor debate performance, Trump's odds began to climb. This was followed by a rally in Republican stocks. However, after Biden dropped out and Harris gained momentum, the so-called Trump trade lost steam. Interestingly, changes in polling and prediction market odds appear to affect stock returns with a lag. Political data contains relevant information on the value of partisan stocks, but only filters into the stock market with a delay. This implies not only a violation of market efficiency, but also a potential arbitrage opportunity. Return on influence. Elon versus crypto. Quote, "If you don't have a seat at the table, you're probably on the menu," end quote. Anonymous political proverb. In investing in influence, we showed that firms investing in political influence in the form of campaign donations tend to outperform the stock market. However, there are many ways to direct a dollar of such investment. What yields the highest return for shareholders? At a high level, there are two contrasting strategies. At one extreme, donors can support a single party or candidate. Most notably, Elon Musk, the world's richest person and former moderate Democrat, has gone all in on Trump. Musk's America PAC, created only 5 months ago, has already spent $118 million, nearly all to support Trump's presidential bid. In addition to his financial support, Musk has made large in-kind contributions to Trump. Since declaring for Trump, he has broadcast a steady stream of pro-Trump posts to his 200 million followers on X, the social media network he owns, and has even been hitting the campaign trail. At the other extreme, one can play both sides. Perhaps the best current example is the Fair Shake PAC, which has raised over $160 million to represent the crypto industry. Most of these funds come directly from the treasuries of crypto-related firms like Coinbase, Ripple, and A16Z. Fair Shake is interesting not only for the sheer size of its war chest, but also for the nonpartisan way it has been deploying it. So far, it has spent $67 million supporting Republican pro-crypto candidates and $47 million backing Democratic ones. It has also spent $14 million to oppose anti-crypto candidates, all of whom happen to be Democrats. Unlike Musk, Fair Shake has stayed out of the presidential election, focusing only on congressional races. Fair Shake's approach has been strategic, targeting lawmakers in close races with strong crypto views. This sophistication marks an improvement from 2022, when the industry's, quote, government relations, end quote, effort was co-opted by Sam Bankman-Fried, who sent over $40 million to Democrats before heading to jail. Both the crypto industry and Elon Musk, by way of Tesla, X, and SpaceX, have faced regulatory and political challenges under the Biden-Harris administration. However, with the 2024 election providing an opportunity to mount a political response, they have opted for virtually opposite strategies. Will Elon's big bet on Trump or Fair Shake's bipartisan down-ballot strategy better advance their respective interests? While we cannot predict the outcome of the upcoming 2024 election, we can assess the expected value of these two strategies based on their average efficacy as applied by hundreds of other firms in past election cycles. Non-partisan investing. Quote, "The mixing of politics and business not only is detrimental to politics, as is frequently observed, but even much more so to business." Ludwig von Mises. Let's start by studying the historical returns of partisan and nonpartisan stocks. In this analysis, partisan stocks are those with a high share of donations to either Democrats or Republican candidates. In contrast, nonpartisan stocks are more balanced in their support of both parties. We present two strategies. Every 2-year cycle, we build nonpartisan and partisan stock portfolios based on trailing political contributions, considering only stocks with a meaningful quantity of total donations. Exhibit 21 shows the returns of these strategies relative to those of the broader U.S. stock market. Since 1997, both strategies have outperformed the broader market. As we showed in Investing in Influence, political influence is an undervalued intangible asset leading to subsequent excess returns. Importantly, however, we find that the outperformance of partisan stocks is considerably less pronounced than that of nonpartisan stocks. Why might this be? First, partisan contributions are more likely to be ideologically driven, motivated by social views and other factors aside from maximizing financial returns. This is not to say that these other issues are not important, just that they are less likely to directly affect the bottom line. Second, partisan donations may be a sign of an excessively partisan work culture. A paper written by Foss and co-authors finds that increased partisanship in executive teams can lead to the ostracization and departure of politically misaligned executives. Political homogeneity may foster harmful groupthink and invite unwelcome controversy. So what do these stocks in the outperforming nonpartisan strategy look like? Exhibit 22 shows a few examples. Companies that take a hedged approach towards investing in influence include large defense contractors, airlines, banks, telecoms, and pharmaceutical companies. Firms in highly regulated sectors cannot afford the risk of backing the wrong political horse. Most of these big corporations also invest heavily in lobbying and organizing their own corporate PACs. Next, let's study the risk of nonpartisan stocks. All else equal, we expect nonpartisan stocks to be less risky than their partisan counterparts, since their exposure to, quote, political shocks, unquote, is more hedged. We test this in Exhibit 23, which shows the rolling 250-day volatility of nonpartisan versus partisan stocks. This exhibit shows the impact of rising political polarization. In 1997, the volatility of nonpartisan and partisan stocks was roughly equal. However, nonpartisan stocks have become relatively less volatile over time. Today, nonpartisan stocks are around 20% less volatile than partisan stocks. A paper by Christensen and co-authors in 2021 obtained a similar result, finding that, quote, political hedging, end quote, is associated with lower volatility in not only stock returns, but also investment levels, tax rates, and earnings. Moreover, they find that the benefits of volatility reduction are particularly pronounced in periods of elevated policy uncertainty, such as elections. Nonpartisan stocks appear to offer the dual benefit of higher return and lower risk. To be clear, these companies are not, quote, apolitical, unquote, abstaining from the political process. On the contrary, they are highly proactive, ensuring that they have a, quote, seat at the table, end quote. That said, they do not let partisan politics get in the way of their business objectives. Corporations, executives, and workers. A second crucial difference between the Musk and Fair Shake strategies is the person or entity directing the funds. In one case, the donations are driven by an individual executive. In the other case, they are directed by a consortium of firms. Let's create two more strategies. First, we'll build an index of companies whose contributions are mainly directed by the corporation itself. Second, we'll study companies whose contributions are mainly directed by individual employees. Exhibit 24 shows the returns of these two strategies relative to those of the broader stock market. Corporate-directed donations deliver a much greater return to equity owners than do employee-directed donations. Corporations are likely more strategic in allocating resources to candidates that represent the interests of the firm and its shareholders. Moreover, corporate donations are more explicitly mentioning the firm's name, increasing its visibility to politicians. Of course, Musk is no ordinary employee. He is a business celebrity, as well as the CEO and principal owner of several major companies. In Exhibit 25, we separate the impact of employee donations from executives and ordinary employees. As before, we look at returns relative to the market. We find that executive donations have not, on average, benefited shareholders. In many cases, these donations may be driven more by executives' personal career and political ambitions than the interests of their firm. So, for example, future cabinet appointments and obtaining personal political influence. Less cynically, politicians may simply be more responsive to the interests of hundreds of small donors rather than those of a single large one. Despite all the money in politics, elections are ultimately vote-weighted, not dollar-weighted. So far, we have identified 3 sources of corporate political donations: the corporation itself, its executives, and its ordinary employees. Exhibit 26 presents examples of companies where each source makes up the vast majority of that firm's total donations. The exhibit highlights a diverse range of companies. Among corporate-driven donors, we see Coinbase, followed by firms with large corporate PACs, such as Valero and CSX. Among executive-driven donors, Tesla and Interactive Brokers are the most extreme, while among ordinary employee-driven donors, we find large tech firms like NVIDIA and Salesforce. Exhibit 27 further decomposes these 3 types of firms by political party using the definitions from earlier. The 3 groups exhibit intuitive partisan alignments. Corporate donors tend to be Republican or nonpartisan, while ordinary employees tend to be Democratic or nonpartisan. Executives display the most bimodal partisan distribution, with a notable Republican lean. Finally, let's break down which types of donors are most important for each industry. Energy, materials, and healthcare firms rely most heavily on corporate donors. Real estate, utilities, and consumer staples firms depend primarily on executive donors, and technology, communications, and financials rely most on non-executive employee donations, likely due to the high compensation in these fields, for example, engineers and bankers. Diversified portfolios. Quote, portfolio concentration may well decrease risk if it raises, as it should, both the intensity with which an investor thinks about a business and the comfort level he must feel with its economic characteristics before buying into it. End quote. Warren Buffett. We have argued that electoral contributions represent investments in political influence. As such, it follows that donors can build, quote, portfolios of candidates, end quote, using similar principles to those investors use to build portfolios of stocks. One frequent debate among stock investors is the trade-off between diversification and concentration. Quantitative investors and academics tend to favor portfolios diversified across many small positions, while discretionary investors, such as Warren Buffett, often prefer to concentrate in a few high-conviction bets. In politics, Elon Musk is following an extreme version of Buffett's concentration philosophy. His political portfolio basically consists of a single candidate, Trump. On the other hand, Fairshake has adopted a much more classical investment approach, spreading its bets across dozens of candidates. We can visualize this difference in Exhibit 29, which compares the candidate portfolios of the Fairshake PAC and America PAC. For each of the 2 candidate portfolios, we calculate a portfolio concentration score based on the Herfindahl-Hirschman Index, HHI. Musk's America PAC has 89% of its money backing Trump, with a balance and a smattering of congressional races. The concentration score of this portfolio is quite high, at 79% out of 100% max. The Fairshake PAC is more diversified, with its top 3 positions comprising less than half of its portfolio. As a result, its concentration score is a much lower 12%. Next, we repeat this portfolio concentration calculation for each stock in each election cycle. We build 2 strategies, one of stocks with diversified candidate portfolios, and another of stocks with concentrated candidate portfolios. As before, we rebalance every election cycle and report returns relative to those of the market. Since 1997, firms with diversified portfolios of candidates outperform those with concentrated ones. Spreading one's political bets across many candidates has produced significant excess returns for shareholders. On the other hand, the strategy of concentrating on a few big bets has failed to create firm value, at least on average. Exhibit 31 shows some current holdings of the outperforming diversified portfolio strategy. We find many of the usual suspects from earlier, such as RTX, Eli Lilly, and CSX. It turns out that the diversified donor factor is modestly correlated with 2 factors shown earlier. In particular, nonpartisan donors are more likely to spread their bets across a greater number of candidates. Similarly, due to contribution limits, corporate PACs tend to donate small amounts to many candidates. Finally, we combine our various donor factors into 2 different multi-factor composites. On one hand, the, quote, Fairshake strategy, end quote, combines the nonpartisan, corporate or ordinary employee, and diversified donor factors. On the other hand, the, quote, Elon Musk strategy, end quote, combines the partisan, executive, and concentrated donor factors. Exhibit 32 shows the back-tested returns of stocks employing these contrasting political strategies relative to those of the broader market. Since 1997, stocks investing in political influence using the, quote, Fairshake strategy, end quote, have historically outperformed those following the, quote, Elon Musk strategy, end quote. While Elon is a brilliant businessman, the historical data suggest that concentrated partisan donations from executives tend to not accrue much value for shareholders, at least on average. As equity investors, we are better off following the crypto industry's lead, buying companies investing in political influence through a diversified portfolio of candidates from both parties, while ignoring outsized executive donations. Conclusion. With the presidential election just 2 weeks away, tensions are running high. In today's polarized political climate, firms and employees are increasingly pressured to take sides. Using political campaign contribution data, we identify the firms and sectors most active in partisan politics. In our paper, Investing in Influence, we found that firms that invest in political influence through campaign donations earned excess stock returns. However, not all contributions have an equally positive impact on stock prices. First, we find that nonpartisan donations have delivered higher returns than partisan donations, while also mitigating political risk. Next, we learn that donations from ordinary employees and corporations themselves have outperformed those from executives. Finally, we observe that companies donating to more diversified rosters of political candidates have outperformed. Over the years, our research has consistently shown that investors can benefit from buying firms with undervalued intangible assets, with political influence being an important category. However, this paper demonstrates that, like any investment, the expected return to political contributions depends greatly on how strategically they were deployed.
If you enjoy the show, be sure to leave us a rating and a review on your favorite platform. You can read investment research like you heard today by subscribing to the Idea Farm's free weekly e-newsletter at theideafarm.com. Thanks for listening, friends, and good investing.